our last meeting, we warned about a more challenging global environment. Some of the risks we saw then have since materialized. In particular, the outlook for monetary policy in the United States has changed. The space for rate cuts by the Federal Reserve now looks limited, with core inflation still elevated and new inflation risks emerging, such as rising tariffs on trade. It is even possible that US rates could go up again to stabilize inflation. Growth outside of the United States is generally more subdued. The largest economies in Europe have had weak economic performance. Germany has had 2 years of contraction, and both France and the United Kingdom have slow growth. At the same time, core inflation remains elevated, and rate cut expectations have been pared back, although less than in the United States. Meanwhile, China's economy has been decelerating, with very low inflation and a marked decline in interest rates. In these circumstances, the US dollar has appreciated strongly and, according to some measures, has reached an all-time high. Turning to South Africa, the economy contracted in the third quarter. This is mostly due to an unusually large drop in agricultural production, which has limited implications for how we interpret the economy's underlying growth trend. For the fourth quarter, we anticipate a rebound. This will be supported by more normal agricultural production as well as strong household spending, given tailwinds including lower inflation and 2-pot pension withdrawals. We think this expected rebound in growth will close the output gap, leaving the economy to operate in line with its potential from the current quarter onwards. We expect potential growth to trend higher over the next few years. This gets growth to about 2% by 2027. Looking at the composition of output since the onset of COVID, mining and manufacturing have underperformed, with output still below pre-pandemic levels. It is only due to growth in the tertiary sector that the economy is bigger now than it was 5 years ago. Similarly, on the demand side, investment has been depressed since COVID, while household and government spending have been more resilient. As growth picks up, we expect more rebalancing with a recovery in investment as well as improvements in the primary and secondary sectors. We will be monitoring the data carefully to assess how closely the economy tracks these projections. The risks to the growth forecast are assessed as balanced. Moving to consumer prices, headline inflation averaged 4.4% last year, near the middle of our target range. Inflation slowed to 3% in December, having started the year above 5%. This was mainly due to favorable goods price developments, including food inflation reaching 15-year lows as well as lower fuel costs. Because of these transitory factors, inflation is likely to remain in the bottom half of our target range through the first half of this year. But headline inflation should revert to around 4.5% thereafter, aided by core inflation, which remains at or below the midpoint over the forecast period horizon. While our exchange rate assumptions have risen towards a weaker rand, the effects on the inflation forecast have been limited. This is mainly because other components of inflation have come in below previous projections, lowering the starting point of the forecast. Inflation expectations have also now largely aligned with our midpoint objective according to the most recent survey. The risks to the inflation outlook are assessed to the upside. In the near term, inflation appears well contained. However, the medium-term outlook is more uncertain than usual, with material risks from external environment. Domestic factors such as administered prices are also problematic. Against this backdrop, the MPC decided to reduce the policy rate by 25 basis points with effect from the 31st of January 2025. 4 members preferred this action, while 2 supported an unchanged stance. The committee ultimately agreed that it was possible to reduce the degree of policy restrictiveness, making the stance somewhat more neutral. However, all members were concerned about the uncertain global outlook. The forecast sees rates drifting slightly lower over the next few years, stabilizing near 7.25%. But this rate path from the quarterly projection model remains a broad policy guide. The MPC would like to emphasize that its decisions will be made on a meeting-by-meeting basis with no forward guidance and no pre-commitment to any specific rate path. Such decisions will continue to be outlook-dependent, responsive to data developments, and sensitive to the balance of risks to the forecast. Given the challenging global environment, the MPC spent some time during this meeting reviewing a trade war scenario. This featured a universal increase of 10 percentage points in US tariffs with retaliatory measures by other countries. The scenario showed higher inflation and interest rates globally, as well as greater risk aversion in financial markets. In response, our model projected the rand depreciating to nearly 21 rand to the US dollar, with domestic inflation reaching 5% and the policy rate 0.5 percentage point higher at its peak relative to baseline forecasts. We also looked at a scenario of accelerated structural reforms domestically. This showed growth picking up gradually, getting to 3% in 2027. Importantly, this scenario also showed lower inflation and lower interest rates in South Africa, demonstrating how structural reforms can reduce the country's risk premium and create more monetary policy space. Considering the difficulties of the external environment, it remains crucial to sustain domestic reform momentum while protecting macroeconomic stability. The MPC's main contribution is to deliver low and stable inflation with well-anchored inflation expectations. The committee remains vigilant and ready to calibrate policy as needed. Additional measures that would improve economic conditions include reaching a prudent public debt level, further repairing and strengthening network industries, lowering administered price inflation, and keeping real wage growth in line with productivity gains.